We're going to calculate the stock price for Baker Hughes. The first thing we need is the market cap. And that's 17.05 billion. And now the stock price, 16.51. And the shares outstanding, you take the market cap divided by the stock price, and you get shares outstanding, which is 1 billion shares. Next, we need free cash flow. And the best way to calculate the stock price for a company is to estimate future free cash flow and discount that number back to today's dollars. And that's exactly what we're doing in this video. Next, we need net income, and we have to go to the income statement for that. And that's the profit and loss for a company. I see some negatives, which makes it a little more difficult to value a company with negatives. But I've revised my model the past month to take into account negatives to try to value a business. Let's see if it works. Now we need to look at the capital structure of BKR to figure out the discount rate we need to apply to the future cash flows. So the interest expense is 237 million. That's the interest they pay on their debt. And let's see how much debt they have. We'll go to the balance sheet. We'll go to liabilities. And current debt, 321 million. And long-term debt is 6 billion. And the difference is current debt is due within 12 months. Long-term debt is due after 12 months. And now we need to figure out the effective tax rate because interest payments on debt are tax deductible. So we have to reduce taxes. So let's see their income before tax. So that looks wrong because their income before tax in 2019 was 750 million and their taxes were 480 million. So that indicates a really high tax rate. Let's go to the prior year. They're all kind of funky. They just don't make sense. That's the hard thing about looking at the income statement is they use accrual accounting. So a lot of the numbers on here actually occurred years ago, and they may be taken into account losses from prior years or other types of depreciation from prior years. So it's really hard to look at 1 year on an income statement. You have to kind of look at many years altogether, which makes it really confusing. Let's just take a standard 20% tax rate. That's probably pretty close to what they pay. So the cost of debt is actually 2.86%. It's similar to a mortgage. If you pay 6% interest on your mortgage, you get a tax write-off of the interest. So you're probably paying closer to like 4% on a mortgage, similar to companies do on debt. Now let's figure out the cost of equity. And we need to get the beta, which is 1.65. And the cost of equity is 15%, and the cost of debt is about 3%. So equity is more expensive than debt because equity sits lower on the capital structure of a company. In the event of a default, debt holders are paid before equity holders. So equity holders require a higher return because of the higher risk they're taking. So the WACC, the weighted average cost of capital, is 11.6%. And this is the discount rate this company uses to figure out investments and to do things like discounted cash flows. It's a combination of their cost of equity and cost of debt. So let's discount the future cash flows by that amount. And we have the estimated future cash flows according to our inputs from earlier. We also have a future value. After 4 years, every year beyond 4 years, we calculate that at 7.7 billion. Then when we discount those numbers back to today using our WACC, we get a value of the company of $8 billion. And when we divide it by 1 billion shares, that comes out to a stock price of about $8. And they're trading at over $16. So they're trading at 100% premium. So this, according to the model, is a sell. And let's look at that stock price historically. So it's always been trading pretty high, much higher a couple of years ago, over almost 70 it looks like. So discounted cash flow models look at prior financial information and forecast numbers out. The future doesn't always mean the same's going to happen as the past. So that's our job as an analyst, to try to identify how the future of the company will perform. And the stock price can obviously trade higher or lower than intrinsic value. It's all based on supply and demand of the market. As more and more people want to buy a stock, the price of the stock gets driven up. As more and more people want to sell a stock, the stock price gets pushed down. So everybody has their own opinion on a stock. This is my model, in my opinion. So thanks for watching.